Investors are faced with uncertainty at a macroeconomic level, and locally we've seen a barrage of events. Things like load shedding, we've had weak economic growth, and of course everybody's worried about government debt levels. Joining me today is Lyle Sankar, Head of Fixed Income at PSG Asset Management. Lyle, to kick us off, maybe you can explain to us, money market yields have been high, but what should investors be thinking about and why should they be considering longer dated bonds?
Yes, Adri, I think that's probably the most important question we're finding from investors. Is it time now to move out of cash-like investments into the longer dated bond market? And I think it's important to just acknowledge, on the one hand, money market funds have played their role to perfection. So they've protected client capital in the last year. As the repo rate has been lifted by the Reserve Bank, these yields have increased as well. And so they've done what investors have needed from them. On the other hand, you've had a very tough bond market, and the bond market has underperformed cash. But when we look at the market right now, we're seeing the repo rate just above 3.5% above inflation, which is quite steep. And we think investors need to be thinking about an environment where these money market yields begin to trend lower. While we don't believe the Reserve Bank will begin to cut rates very quickly, we do think that the likelihood from here is that these rates will come down in future. So if you're thinking about a bond investment, bond yields are very correlated to the repo rate. And as just one element of a bond investment, we think this sets up an environment where bond yields will come down lower and these money market yields will also trend lower, setting up performance or outperformance from income funds in that environment.
But aren't longer dated bonds risky, especially local SA government bonds?
Yeah, I think it's an important question. I think, firstly, we always try to make sure that we don't expose clients to high risk of losing capital. And that's the same when we look at government bonds. So I think to contextualize how you lose money in a government bond, you need runaway inflation or you need a debt issue. So the first element, as I pointed out, is South Africa doesn't have an inflation issue. We don't have the inflation, the likes of what we saw in Turkey this year, where they experienced 80% inflation, or that of developed markets, where they're still battling to bring inflation under control. We think we are going to be just fine from an inflation perspective. The second part is the debt in South Africa, and I think everybody is well versed that we've underperformed on a revenue collection basis this year, and we are going to miss on budget expectations. Now, I think when we're looking at an 80% debt to GDP forecast in the year ahead, it does seem quite high relative to the low growth we're experiencing, and we would share some of the concerns in the market that South Africa has multiple constraints to performing at a reasonable growth level. But we think it's quite important to just consider some of the detail behind the headline GDP, debt to GDP figure. And that for us, we specifically reference the debt maturity profile. When you look at some of the detail, we think there's some attractive aspects that you need to consider. It's well known that South Africa has a very long dated debt maturity profile. But what's quite telling when you look at the detail is that in the next 4 years, South Africa has less than 15% of its debt maturing. So this does two things. The first is that it ensures we don't have a fast upward spiraling interest bill. Our interest bill will increase, but it will be at a slow grind upwards. The second thing is that it provides you with well-needed time to sort out the supply or growth constraints in the economy. So from that perspective, we're not premising our investment in government bonds on a high growth environment, but we do think even in a muddle-through world, South African investors will be fine with bond yields at 12%, inflation well contained. You are likely to earn very good inflation-beating returns. And the second part of it is when you buy these government bonds, you also buy the optionality to a much better environment or even slightly improved. And here we talk about a little bit of better improvement in the commodity cycle, as well as the exposure to potential rate cuts, which we think in that type of environment, the bonds will deliver equity-like returns.
Lyle, so with all the uncertainty locally, many investors are looking at offshore bonds and they think they're looking attractive. Right now, developed market bonds are at 15-year highs, and as we know, you can also earn real hard cash yields on them. So the question for investors are, should they be considering them? And how does PSG Asset Management consider these bonds as part of our portfolios?
Yes, that's correct, Adriana. I mean, these bonds are the highest since we've seen since the GFC. I think from a portfolio construction perspective, it's always important to consider offshore diversification. We would just remain a little bit cautious on whether you introduce these developed market bond deals into your portfolio. And this is for two reasons. The first being is that we'd like to challenge the view that inflation is likely to be contained around the 2% level in these developed markets in the years ahead. We think rather you're going to experience an environment with high inflation, but more volatile inflation, as it will take much longer than what is priced into markets at present. The second aspect, and most concerning for us, is the debt levels and trajectory of debt in these developed markets. If you look at the US, for example, they continue to print budget deficits alongside a massive maturity profile, almost 45% of their debt maturing in the next 4 years, which will require refinancing at almost 4 to 5% higher yields. And so for us, this presents two aspects that are likely to put upward pressure on yields. And as we saw last year in 2022, this can be quite detrimental to clients that have exposure to those markets. So we do believe offshore exposure is quite sensible, but we'd be limiting that to short-term cash alongside a healthy exposure to South African assets.
So Lyle, as portfolio manager for the PSG Diversified Income Fund, how do you take all of these diverse factors and blend them as part of your portfolio construction to secure the necessary yields for investors?
Sure. So I think it's important to always emphasize that we remain focused on managing risk. The PSG Diversified Income Fund is a safe store of capital and a portfolio that we want to just get attractive risk-adjusted yields for clients. So managing risk would be one, preserving capital, but as well as managing short-term volatility. In many ways, in South Africa right now, we are quite blessed and we've got attractive real yields all the way from cash to long-dated bonds. And in that sense, you can build a very attractive portfolio in this type of environment. So we'd be focused on a healthy exposure to government bonds, as well as fixed rate bank instruments, which we think will protect you in a muddle-through environment, but as well as give you the optionality for a slightly better backdrop in South Africa in the years ahead. The one area that we would remain cautious and have been for a while is exposure to the corporate bond market. Here we believe the compensation for risk is quite poor. It brings complexity to a portfolio as well as illiquidity. And we do think from time to time you do see pitfalls in our market, which may be on the horizon in certain parts of that space. So if you put this together, I think the PSG Diversified Income Fund with a running yield of 10% is likely to give clients inflation-beating returns, and it's a risk-adjusted portfolio that will be a very safe place for clients' capital. So very excited about the prospects for this portfolio.
Lyle, thank you so much for joining us and sharing your insights about the fixed income market.
Thank you, Audrey.